Market on close. We've got about 10 minutes left in the trading day on Wall Street and for the week. Time now for the big picture. For that, I want to welcome in from our team at Charles Schwab, Cooper Howard, Director and Fixed Income Strategist, Schwab Center for Financial Research. Cooper, I haven't talked to you in a while. It's good to see you. All right, let's talk about the Fed meeting this week. This is the week we were looking towards, not for obviously the Fed to make a move on rates, but the indication of what's to come. What appears to be in the cards is two cuts still this year. What's your takeaway overall when you read between the lines?
You know, I think that it's great to be back, Diane. So thank you very much for having me. It's good to chat. We haven't done so in a while, like you mentioned. I wouldn't necessarily say that two rate cuts are in the cards. I think if you look at the dots plot, what was notable to me is that 7 officials projected that there were going to be no cuts. And then you saw another 8 officials project that there were going to be 2 cuts this year. So kind of a barbell approach to what Fed officials are expecting. And I think that that's relatively appropriate. Now, our team is still expecting between 1 and 2 cuts this year, depending on how the data plays out. Looks like, based off of Powell's comments on Wednesday, that they're more focused on inflation than they are on the labor market. Or excuse me, the other way around. They're more focused on the labor market than inflation. So we've started to see some cracks in the labor market. Inflation's holding steady right now, depending on what measure you look at, say 2.5%, 3%, somewhere in there. But if we continue to see the labor market deteriorate a little bit more, then I'd lean more towards those 2. But again, there's a lot up in the air.
Okay, a lot up in the air. And speaking of that, you had some comments in a CNBC interview from Fed Governor Chris Waller, who seemed to potentially open the door to a July rate cut, saying, you know, this could happen then. How do you interpret that potential disconnect?
Yeah, so also if you look at the dots plot, there were 2 dots that projected 3 rate cuts. So I believe probably one of those dots is Waller. It would be a little early, in my opinion, if we see a Fed rate cut in July. If you look back at the history of this Fed, really they've laid a lot of breadcrumbs anytime that they've wanted to cut interest rates. So usually it's something that's opened the door in the statement, or maybe the press conference. Powell leaves a little bit of a breadcrumb that they're projecting a rate cut at potentially the next meeting. That wasn't something that happened. Just Wednesday, we heard that Chairman Powell is considering where we're at is a relatively good place with rates. So I'd be a little surprised if we cut in July, given that there really hasn't been kind of a sprinkling or a little bit of an indication that we are cutting in July.
And then how should fixed income investors just interpret the Fed's messaging right now? What do you see, overall as their takeaways? Because I know you said, you point out that there was 7 on one side, 8 on another. That's, obviously notable. So what should the interpretation be?
I think that the interpretation is that the bias is that they're going to continue to cut rates, or they want to continue to cut rates so long as the data holds up as they expect, or so long as the economy performs as they expect. So our expectation, again, is that rate cuts are coming. So I think for investors, the implication that we've been talking to a lot of our investors about, Diane, is that if they have been holding larger cash allocations, that consider moving out the yield curve with some of those, because once the Fed does start to cut interest rates, then yields for short-term investments are going to move lower and you're faced with reinvestment risk.
Okay, and then Cooper, I'm curious to know, I know you have some thoughts on munis, especially when it comes to higher income earners. What's your view there?
Yeah, so like your previous guest had mentioned, we've seen the 10-year Treasury kind of trade around in a little bit of a range and be moving sideways recently. But if you look at an area of opportunity, we do think that that is the municipal bond market. So just looking at the yield of a broad index of munis, this is going to be shorter term, longer term, higher yielding or higher rated, lower rated. It yields about 4%. Given the tax advantageous nature that munis offer, that they are generally exempt from federal income taxes and state income taxes, we think that that's pretty attractive. Combine that with average credit quality to where about 7 out of 10 of those bonds in that index are either AAA rated or AA rated. Again, we think that that adds some fuel to the fire, and that's another reason where we think that munis can be an attractive option for investors who are in higher tax brackets. So that is one area of opportunity that our team right now is discussing.
And then when you said the team is discussing that area of opportunity, and I get what you're saying, especially when it comes to a higher tax bracket. What are the potential trade-offs or risks?
I think just like any other fixed income investment, there's the potential risk of higher interest rates. Obviously, that's going to lead to a decline in prices and negative total returns. Also, if you look at the index as a whole or performance of the municipal bond market, it has been one of the worst performing parts of the fixed income market this year so far. A lot of that's because of high issuance. So there was the One Big Beautiful Bill Act that it obviously did not exempt the municipal bond tax exemption, but many issuers had concerns that it might impact the tax exemption, so they rushed to market and you saw issuance be at record level highs this year. That's really been a negative for total return. So one of the concerns is that if we continue to see high record levels of issuance, that could weigh on prices and therefore total returns, Diane.
And tell me a little bit more about what you're seeing and noticing when it comes to the impact of the Big Beautiful Bill that's working its way through Congress across fixed income.
Yeah, so across fixed income, I think the big thing is, given that it's tax policy, our focus is on how can it impact the municipal bond market directly. One of the things that I do think is that it wasn't a big negative for the municipal bond market because it did leave intact the municipal bond tax exemption. It also didn't restrict any issuer's ability to issue tax exempt munis. So it's kind of status quo, if you will, from a tax perspective. Longer term, there might be some credit impacts to certain sectors. So for example, there might be cuts to Medicaid. And if it is successful in shifting more of the cost to Medicaid to states rather than the federal government, that would just reduce their overall ability to meet debt service going forward. So that's somewhat of a headwind there.
Yeah, and look, that's been a big push from the government to shift that piece to states versus the federal level. We'll certainly continue to follow the progress when it comes to the Big Beautiful Bill making its way through Congress. Cooper, thank you. That's our Cooper Howard, Director and Fixed Income Strategist, Schwab Center for Financial Research.